Asia's markets are a powerful force in the global economy, acting as both a barometer and a catalyst for global trends. Every day, billions of dollars flow through Asian exchanges, reflecting the hopes, fears, and ambitions of investors, from Tokyo to Mumbai. The influence of these markets stretches far beyond their borders, shaping everything from global supply chains to the mood of investors on Wall Street and beyond. When Asia moves, the world pays attention. The continent's diversity is striking. Home to both emerging economies and established powerhouses, Asia is a mosaic of cultures, industries, and ambitions. This diversity means that shocks or surges in one country can quickly ripple across the region and the globe. China's vast manufacturing sector, for example, is so deeply integrated into global trade that even a slight slowdown can disrupt supply chains worldwide, affecting everything from electronics to automobiles. Meanwhile, South Korea's innovative tech sector is at the forefront of shaping entire industries, from semiconductors to electric vehicles, setting trends that reverberate across continents. What happens in major financial centers like Tokyo, Shanghai, or Seoul often sets the tone for trading in Europe and the Americas, as investors look to Asia for early signals on market direction. This week, Asia's financial narrative was a fascinating mix of caution and celebration, reflecting the region's complexity and dynamism. New economic data from China signaled that its once unstoppable economic engine might be losing steam, raising concerns about the broader impact on global growth. This slowdown sent ripples of unease through regional markets, as investors braced for potential aftershocks in industries worldwide. In sharp contrast, South Korea's main stock index soared to a record high, buoyed by optimism in its booming technology sector and strong corporate earnings. The country's tech giants continue to drive innovation, fueling investor confidence and pushing the market to new heights. Meanwhile, Australia stands at a crossroads, with markets on edge ahead of a pivotal central bank decision that could influence interest rates and economic policy for months to come. As we dive into the week's market activity, we'll unpack these contrasting stories, exploring how Asia's fortunes are intertwined with the rest of the world, and why what happens here matters everywhere. By the end, you'll understand why Asia's markets aren't just a regional story. They're a bellwether for the entire global economy, shaping the future for us all. China's private manufacturing PMI, a key gauge of factory health and a closely watched indicator by economists and investors around the world, came in at 50.6 for October, down from 51.2 in September, and falling short of market expectations. This number, while still above the 50 mark that separates expansion from contraction, signals a notable slowdown in momentum. While the PMI remains in expansion territory, the deceleration has sparked fresh concerns about the durability and strength of China's post-pandemic recovery. Many analysts had hoped for a stronger rebound, but the latest figures suggest that growth is losing steam. The data revealed sluggishness in both domestic and international demand for Chinese goods. Sub-indexes tracking new orders and export sales both softened, indicating that customers at home and abroad are holding back on purchases. Factory output also decelerated, with fewer new requests coming in and less production taking place on the shop floor. This slowdown is being felt across the supply chain, from raw material suppliers to finished goods manufacturers. The impact is significant, affecting everything from jobs in industrial cities, where many depend on factory work, to the profits of suppliers and logistics companies that move goods across the globe. The modest expansion in the PMI suggests that China's manufacturing sector has lost much of its earlier momentum, raising important questions about whether the government will introduce new stimulus measures to support growth. For global companies that rely on China as a manufacturing hub and a key market, this data serves as a clear warning sign. Slower growth in China can ripple out to affect supply chains and business plans worldwide. Investors are now reevaluating their forecasts and strategies, watching closely for any signs of further weakness or potential policy responses from Beijing. Ultimately, the PMI is a flashing yellow light for China's economy and the world, signaling caution and the need for vigilance as the global economy navigates uncertain times. China's disappointing PMI data, which measures the health of the manufacturing sector, sent ripples through the financial markets. This data triggered a swift reaction in its stock markets, as investors quickly reassessed their positions. The CSI 300 index, which tracks China's largest companies, fell 0.5%. This decline reflected investor worries about future profitability and the overall economic outlook. Meanwhile, the broader Shanghai Composite stayed flat, indicating a market in a wait-and-see mode. Investors seemed to be holding their breath, waiting for more concrete signs of economic recovery. Investors were hesitant, with the weak manufacturing data casting a shadow over short-term prospects. The uncertainty made many traders cautious, unsure of the next move. In Hong Kong, however, the Hang Seng Index rose 0.6%, defying the mainland's gloom. This rise was a surprising contrast to the mainland markets. International investors sometimes see Hong Kong as a safe haven or spot bargains when mainland markets stumble. This perception can lead to divergent market movements. A positive lead from Wall Street also helped lift sentiment in Hong Kong. The global market's performance often influences local investor confidence. This divergence highlights the complex relationship between the two markets. While they are interconnected, they can react differently to the same economic data. While caution dominated in China, some investors in Hong Kong looked ahead, hoping for stimulus or focusing on global cues. This forward-looking approach can sometimes pay off. Still, the drop in the CSI 300 was the clearest sign of concern about China's economic momentum. It underscored the challenges facing the Chinese economy. The region's mood was cautious, but not without pockets of optimism. Investors are navigating a complex landscape, balancing short-term concerns with long-term opportunities. While China's markets wavered, South Korea's KOSPI index soared, jumping 2.4% to a record high. The surge was driven by the powerhouse tech sector, especially semiconductor giants. SK Hynix led the rally, with shares skyrocketing over 10% after reporting record-breaking profits. Samsung Electronics also posted strong gains, reinforcing the tech sector's dominance. The rally was fueled by robust global demand for memory chips and high-tech components. Investors saw South Korea's tech industry as a bright spot amid regional uncertainty. The combined strength of SK Hynix and Samsung created a wave of optimism. The KOSPI's historic high signaled confidence in South Korea's economic future. Amid Asia's mixed signals, South Korea's tech boom stood out. South Korea's market rally was grounded in strong economic data, not just sentiment. October exports grew 3.6% year-over-year, beating expectations and showcasing the country's resilience. The standout semiconductor exports, which soared 25.4%, highlighting relentless global demand. This export boom directly fueled the profits and stock prices of SK Hynix and Samsung. High demand for electronics means factories are busy and revenues are up. The data confirmed that South Korea is capitalizing on the digital transformation sweeping industries worldwide. In contrast to China's slowdown, South Korea's export engine is running at full speed. Investors recognized a compelling growth story, pushing the KOSPI to new heights. South Korea's tech dominance is powering its market success. In Australia, the mood was one of cautious anticipation, as investors awaited the Reserve Bank's interest rate decision. The S&P/ASX 200 index traded flat, reflecting uncertainty. The RBA is expected to keep rates on hold at 3.6%, but persistent inflation complicates the outlook. Recent data showed consumer prices rising faster than the central bank's target, with annual inflation at 3.2%. Core inflation remains high, suggesting widespread price pressures. Hopes for early rate cuts have faded. Now, the focus is on how long rates will stay elevated. Higher rates could slow growth, making investors wary. The market is holding its breath for the RBA's next move. Australia's inflation battle is keeping everyone on edge. Australia's banking sector offered a rare bright spot amid market caution. Westpac, one of the nation's big four banks, reported a slight profit drop, but still beat analyst expectations. The result sparked a 2% jump in Westpac's stock, providing relief to investors. Strong bank performance suggests resilience in the broader economy, even with higher rates and inflation. Households and businesses are managing to meet loan repayments, signaling stability. Westpac's earnings beat was a welcome surprise in a flat market. It's a reminder that individual company results can still drive market optimism. Even in uncertain times, strong fundamentals matter. Beyond the big headlines, Other Asian markets painted a mixed picture. Singapore's Straits Times Index gained 0.4%, buoyed by positive cues from Wall Street and South Korea. India's Nifty 50 opened flat, reflecting a pause as investors weighed mixed regional signals. Japanese markets were closed for a public holiday, reducing trading volumes across Asia. The absence of Tokyo left investors with one less major indicator. These moves highlight Asia's diversity. Some markets edged up, others stood still. South Korea's rally was the exception in an otherwise subdued region. Asia's markets are moving in many directions, not just one. This week's Asian market moves offer a lesson for global investors. Regional differences matter more than ever. China's slowdown and South Korea's tech-fueled rally show that a one-size-fits-all approach won't work. Understanding local drivers, manufacturing data, tech exports, inflation is crucial for smart investing. China's PMI slowdown could impact global supply chains and demand, while South Korea's chip boom shows where growth still thrives. Investors should watch for policy signals and focus on sectors with strong fundamentals. Asia's complexity brings both risks and opportunities. Diligence and a nuanced perspective are key to navigating this landscape. By tracking these diverse stories, investors can better position themselves for success in a changing world.